September 16th, 2020. That's the day Snowflake went public and changed everything we thought we knew about IPO valuations. When the dust settled on that first trading day, this cloud data company had achieved something almost unthinkable: a market cap of over $70 billion for a business that was still losing money. But here's the thing about Snowflake's IPO story. It wasn't just about the eye-popping numbers. It was about perfect timing, brilliant positioning, and a business model that promised to reshape how companies handle their most valuable asset: data. Picture this. While most of the world was locked down, scrambling to figure out remote work and digital everything, Snowflake was quietly building the infrastructure that would power this new reality. Companies that had been dragging their feet on cloud migration suddenly found themselves with no choice. The old way of doing things, keeping data locked up in expensive on-premise servers, wasn't going to cut it anymore, and Snowflake was right there, ready to catch them. Let's start with what Snowflake actually does, because understanding their business model is crucial to grasping why investors went absolutely wild for this stock. Snowflake built what they call a cloud data platform. Think of it as a massive, super smart warehouse where companies can store all their data and then analyze it without worrying about the technical headaches. Unlike traditional data warehouses that required companies to buy expensive hardware and hire armies of IT specialists, Snowflake's platform runs entirely in the cloud. Companies just plug in, upload their data, and start getting insights. But here's where it gets really interesting. Traditional enterprise software companies had been stuck in this old-school model of selling annual licenses. You pay us $50,000 up front, and you get to use our software for a year, whether you actually use it or not. It's like paying for a gym membership and only going twice. Snowflake flipped this entire concept on its head. The genius of Snowflake's revenue model lies in its consumption-based pricing. Instead of charging fixed monthly fees like most software companies, Snowflake charges customers based on how much computing power and storage they actually use. It's like paying for electricity. The more you use, the more you pay. This created a beautiful flywheel effect. As companies stored more data and ran more analyses, Snowflake's revenue automatically grew without any additional sales effort. Think about it. Every time a customer runs a query, processes a report, or analyzes a data set, Snowflake makes money. It's the ultimate scalable business model. In the quarters leading up to the IPO, this model was producing incredible results. Revenue had exploded from around $96 million in fiscal 2019 to over $265 million in fiscal 2020. That's a growth rate of 174%. But these weren't just big numbers on a spreadsheet. Each dollar represented real companies solving real problems. A retail chain analyzing customer behavior in real time. A healthcare company processing patient data to improve outcomes. A financial services firm detecting fraud patterns across millions of transactions. But revenue growth was just part of the story. Snowflake had cracked the code on something that makes investors salivate: net revenue retention. This metric measures how much existing customers increase their spending over time, and Snowflake's number was off the charts at 158%. That means if a customer spent $100,000 with Snowflake in year one, they were spending $158,000 in year two on average. This wasn't just growth. It was compounding, predictable growth from a sticky customer base. What made this number so remarkable was what it revealed about customer behavior. Companies weren't just renewing their contracts, they were expanding them dramatically. Once organizations got a taste of what real-time data analysis could do for their business, they couldn't get enough. Marketing teams wanted to analyze campaign performance. Operations teams needed supply chain insights. Finance teams demanded better forecasting models. Each department that touched Snowflake's platform became another growth driver for the company's revenue. The company's gross margins were equally impressive, hovering around 62% at the time of the IPO. For every dollar of revenue, Snowflake kept about 62 cents after paying for the cloud infrastructure costs to Amazon Web Services, Microsoft Azure, and Google Cloud Platform. These margins were expanding too, which suggested as Snowflake scaled, it would become increasingly profitable on each dollar of revenue. This was the holy grail of software businesses, a model that got more efficient with scale, not less. Now, let's talk about the valuation logic that had everyone either cheering or scratching their heads. When Snowflake priced its IPO at $120 per share, it created a market capitalization of about $33 billion, with trailing 12-month revenue of around $533 million. That translated to a price-to-sales multiple of roughly 62 times. To put that in perspective, most mature software companies trade at 5 to 10 times revenue. Even high-growth cloud companies rarely exceed 30 times revenue. So how did investors justify paying 62 times revenue for an unprofitable company? The answer lies in the growth trajectory and market opportunity. Analysts were betting that Snowflake could maintain triple-digit growth rates for several more years. If the company could double its revenue annually, which seemed plausible given its track record, that 62 times multiple would quickly compress to 30 times, then 15 times, and eventually reach more reasonable levels as the company matured. The math was compelling, even if it required a leap of faith. Imagine you're buying a stock at 60 times revenue, but that revenue doubles every year. In year 2, you're paying 30 times revenue. Year 3, 15 times. Year 4, 7.5 times. Suddenly, what looked like an insane valuation starts to make sense if you believed in the growth story. The total addressable market story was equally compelling. Snowflake estimated the cloud data platform market at $81 billion and growing rapidly. Traditional data warehouses from companies like Oracle and IBM were being disrupted by cloud-native solutions, and the pandemic had accelerated digital transformation initiatives across every industry. Companies were generating more data than ever and desperately needed better ways to analyze it for competitive advantage. But let's be honest about the risks, because they were substantial and very real. The biggest threat came from the cloud giants themselves, Amazon, Microsoft, and Google. These companies provided the underlying infrastructure that Snowflake relied on, but they were also building competing data warehouse services. Amazon Redshift, Google BigQuery, and Microsoft Azure Synapse were all gunning for the same customers. The risk was that these tech titans could undercut Snowflake on price or bundle their data services with other cloud offerings to win deals. Think about the awkward position this put Snowflake in. They were essentially renting office space from their biggest competitors. Amazon Web Services was happy to collect infrastructure fees from Snowflake while simultaneously trying to steal their customers with Redshift. It was like renting office space from your main rival. They know exactly how much money you're making and can use that information against you. There was also the classic growth company risk. What happens when the growth slows down? Snowflake was priced for perfection, assuming it could maintain its blistering pace of expansion indefinitely. Any sign of deceleration would likely trigger a massive stock price correction. The company was also burning cash. About $177 million in the 12 months before the IPO, so it needed to eventually prove it could generate sustainable profits. Competition wasn't just coming from the cloud giants either. Established players like Teradata and newer entrants like Databricks were all fighting for market share in the data analytics space. Snowflake had to continuously innovate and expand its platform capabilities to stay ahead of the pack. In the fast-moving world of enterprise software, today's breakthrough feature becomes tomorrow's table stakes. Now, here's where the story gets really interesting. Who actually benefited from this IPO bonanza? The answer reveals a lot about how modern IPOs work and why timing matters so much. The biggest winners were undoubtedly the early investors who had backed Snowflake through its private funding rounds. Sequoia Capital, which led multiple rounds starting from the company's Series A, saw their investment multiply by enormous factors. These weren't just good returns, they were generational wealth-creating returns that justify entire venture capital funds. Sutter Hill Ventures, Altimeter Capital, and Dragoonier Investment Group all scored massive returns as well. But here's what's fascinating about venture capital math. Even if 9 out of 10 investments fail completely, one snowflake-sized winner can make the entire fund incredibly successful. This is why VCs are willing to bet on seemingly crazy valuations in private markets. They're not just buying a piece of a company, they're buying lottery tickets where the winning ticket can pay out thousands of times the original investment. But the most fascinating aspect was the involvement of two unlikely bedfellows, Berkshire Hathaway and Salesforce. Both companies agreed to purchase $250 million worth of shares at the IPO price in concurrent private placements. For Salesforce, this made strategic sense. They had been an investor in Snowflake's private rounds and saw opportunities for partnership and integration. Mark Benioff understood that in the world of enterprise software, data was becoming the new oil, and Snowflake was building the refinery. But Berkshire Hathaway's involvement was absolutely shocking. Warren Buffett had famously avoided tech stocks for decades, preferring businesses he could understand and predictable cash flows. Think Coca-Cola, not cloud computing. Yet here was Berkshire, not only buying $250 million at the IPO price, but also purchasing an additional 4 million shares from existing shareholders in a secondary transaction. The total investment was over $800 million. What changed Buffett's mind? While he never fully explained the rationale publicly, industry observers speculated that Snowflake's consumption-based model reminded him of utilities, companies that make money every time customers flip a switch. The more data companies processed, the more money Snowflake made. It was predictable, scalable, and had the kind of economic moats that Buffett loved. The Berkshire investment sent a powerful signal to the market. If the Oracle of Omaha was willing to bet big on Snowflake, maybe this wasn't just another overvalued tech stock. Maybe there was real, durable value being created. This endorsement likely contributed to the stock's explosive first-day performance when shares opened at $245, more than double the IPO price. For retail investors, the story was more complicated and often frustrating. Those lucky enough to get IPO allocations through their brokers made instant fortunes, but most individual investors had to buy shares on the open market after the stock had already doubled. The IPO allocation process heavily favored institutional investors and high-net-worth clients of major investment banks. The average retail investor with a few $1,000s in their Robinhood account had virtually no chance of getting shares at the IPO price. Many retail investors who bought in the first few days or weeks saw significant gains as the stock continued climbing, but they were essentially paying a premium for the privilege of owning shares that institutions had already purchased at much lower prices. It highlighted one of the fundamental inequalities in the IPO process. The biggest gains often go to those who already have the most money. The employees and founders also did extremely well, though many were subject to lockup periods that prevented them from selling immediately. CEO Frank Slootman, who had joined Snowflake in 2019 after successful stints at Domain Data and ServiceNow, saw his equity stake become worth billions overnight. For many employees who had joined the company in the early days, the IPO represented life-changing wealth, enough to pay off student loans, buy homes, or achieve financial independence. So why was Snowflake's IPO such a massive success? The timing was absolutely perfect, like catching lightning in a bottle. The pandemic had accelerated digital transformation initiatives across every industry. Companies that had been planning multi-year cloud migrations suddenly needed to digitize everything in months. Remote work created new data challenges and opportunities. The need for real-time analytics and data-driven decision-making had never been more urgent. Consider what was happening in the broader business world during 2020. Retail companies needed to understand e-commerce patterns as brick-and-mortar stores closed. Healthcare organizations required real-time data to track pandemic spread and manage resources. Financial services firms had to detect new types of fraud as digital transactions exploded. Every industry was generating more data than ever before and desperately needed tools to make sense of it all. The cloud infrastructure market had also matured to the point where companies were comfortable running mission-critical workloads in the cloud. Amazon Web Services, Microsoft Azure, and Google Cloud Platform had proven their reliability and security, which made Snowflake's cloud-native approach more palatable to enterprise customers who might have been skeptical just a few years earlier. The infrastructure was finally ready to support the vision that Snowflake was selling. Snowflake also benefited from being genuinely differentiated in a crowded market. While there were plenty of data warehouse and analytics companies, Snowflake's architecture was uniquely designed for the cloud era. Their separation of storage and compute allowed customers to scale each independently, which was more cost-effective than traditional approaches. The platform's ability to handle structured and semi-structured data, along with its support for multiple programming languages and tools, made it attractive to a broad range of use cases. The company's go-to-market strategy was also brilliant. Instead of trying to compete directly with established players on price, Snowflake focused on delivering superior performance and ease of use. They made it incredibly simple for companies to get started with their platform, often allowing customers to see value within days rather than months. This land and expand approach, combined with the consumption-based pricing model, created a powerful growth engine that fed on itself. The broader market environment in 2020 was also incredibly favorable for high-growth tech stocks. Interest rates were near zero, which made investors more willing to pay premium valuations for companies with strong growth prospects. When you can borrow money for essentially free, paying 60 times revenue for a fast-growing company starts to look more reasonable. The pandemic had accelerated the adoption of cloud technologies across every sector, creating a rising tide that lifted all cloud stocks. Looking back now, Snowflake's IPO represents a perfect storm of factors: a genuinely innovative product, massive market opportunity, perfect timing with digital transformation trends, endorsement from respected investors like Berkshire Hathaway, and a market environment that rewarded growth above all else. The company had built a business model that was not just growing rapidly, but getting stronger with scale, as more data and more users created network effects that made the platform increasingly valuable. The success also highlighted how IPO dynamics had evolved. The involvement of strategic investors like Berkshire and Salesforce, the massive first-day pop, and the retail investor frenzy all reflected a new era where public market debuts had become major cultural and financial events, not just capital-raising exercises. Social media amplified every aspect of the story, from the initial pricing to the first-day trading action. For investors trying to understand what made Snowflake special, the key was recognizing that this wasn't just another software company. It was a platform that sat at the intersection of several massive technology trends: cloud computing, big data, artificial intelligence, and digital transformation. The company had positioned itself as essential infrastructure for the data-driven economy, which justified the premium valuation in the eyes of many investors. The IPO's success also validated the broader thesis that cloud-native companies with consumption-based business models could achieve unprecedented scale and profitability. Snowflake proved that investors were willing to pay enormous multiples for businesses that could demonstrate sustainable, compounding growth in large, addressable markets. It opened the door for other consumption-based companies to pursue similar strategies. Of course, the story didn't end on IPO day. Like many high-flying growth stocks, Snowflake shares experienced significant volatility in the months and years following its public debut. The company faced the ongoing challenge of living up to its lofty valuation while navigating increased competition and a more challenging macroeconomic environment. But the IPO itself remains a landmark event that demonstrated how the right combination of product innovation, market timing, and investor sentiment could create extraordinary value in a very short period of time.